Peter, good to have you with us. What's on your radar this morning? Is it all about the Fed, or are you tracking something else?
Well, good morning, Abha, and thank you for inviting me on the show. A couple of things. First off, yes, very much so about Dudley and what's happening there as far as Yellen at Jackson Hole this Friday. The mood, I think, is probably switching around since we spoke last week or so. I think that there's a general consensus now that we may see some traction in September. And the reasoning why, you've got an election coming up in November, of course. We'll know what's going on very much by early December as far as results, and that in turn is going to impact the Fed moving forward. And I think that if they're going to do something, they've got to move quicker than slower. And that's the major concern at the moment. So, yeah, it's a slow week. And as they say in the US and certainly around New York, it's a dog day afternoon, or a dog days, those hot summer August days.
Morning, Peter. Well, one of the things that I've noticed in the last maybe 6 months, 12 months, or actually maybe even 2-3 years now, that the Federal Reserve for sure, but most of the central banks are really playing to the gallery now rather than really focusing on economy. Is it possible that the Federal Reserve's main concern is unemployment rather than interest rates? And in fact, it's one of their mandates to look at the labor market, and that if it sees the risk of unemployment, it actually doesn't do anything with the interest rates and maybe let sleeping dogs lie.
Well, I think you're possibly right, Ashu. There is no doubt that I think that America's situation, very similar to Australia, yes, they're posting these wonderful numbers as far as new job creation and so on, but there's still a high degree as far as underemployment. And anyone that's working, 5 to 10 hours a week has basically said, oh, yes, well, you're employed. So that's the issue, certainly, with graduates coming out of universities and across pretty much the whole world. There seems to be a general feel that there's a lot of underemployment, and that's a large concern, and that's probably going to be the unknown, what Yellen's prepared to do over the next, 48 to 72 hours. Either she's going to move or she's going to have to sit on her hands. But yes, very much so as far as those major labour concerns for all growing economies, and India is no different to that.
Peter, one of the best benchmarks for an increase in commodity prices is what's happening in Australia and what's happening in Indonesia. I remember in the heydays of the commodities boom, guys with sugar plants were looking for coal mines or coal assets in both Australia and Indonesia, and a lot of Australian companies were actually raising money to buy up all kinds of stuff in Africa. And many of these were not even JORC compliant at that moment, which means they hadn't even run samples. Have you seen a pickup in that activity, Peter? Because that's one of the best indicators of whether we'll have a commodity boom.
Well, exactly right. I mean, where we've seen, there is no doubt that those guys looked at all forms of opportunity, and that was very much their mandate to, try and gather as much resources as they could, either, agriculture or, of course, minerals, and to try and it was better than money in the bank. That was their ideology anyway, going back the best part of the decade. That's quickly changed with price meltdowns. Where you're looking at the moment, we've seen a nice uptick as far as agricultural prices in Chicago and so on. I think that you're probably at a bottom end of the scale for a lot of these minerals and metals. The oil market's a little bit different. I think we've just got a classic oversupply, and you've got you're vying for competition with the large producers and the small producers. But when you're looking at the large Glencores and these sort of large commodity players, the Louis Dreyfuses and so on, there is no doubt that using big strategic plays to take on board as much control as they can and buying at these cheaper prices.
What's your take on oil, Peter? We talked about this last week as well, but things, of course, have evolved. Where do you feel oil's going to sort of stabilize at?
Well, when I look at it, Abha, when you think of what's happened this month, it's been quite dramatic. Since the 2nd of August, we had lows there of 39. They tickled up to the best part of 49 to 48. Then they've come back, so that was, all within a matter of all within a matter of days. We saw another correction overnight. Brent was a little bit steady. It actually had some upward trend, but WTI was hit again. So it just seems to be that they're very much controlled as far as, the hedge funds, large players, and we saw that, that accumulation phase. What we observed with that short selling as far as the hedge funds, that accumulation phase went very much to a liquidation phase, and then you've seen a reversal, and a very violent one when you're looking at where you were a couple of weeks back. The trade became very crowded to the upside. I think it squeezed all of those short sellers, and they would have got burnt if they were still holding. And then it's gone all the way through, ratcheted up to, that 48, 49, and now a little bit of that steam's coming out of the market. We've got Baker Hughes rig counts through the 400s, and that's having a little bit of a joyful time. So I think at the present time, I wouldn't be surprised to see a little bit further softening as far as crude. We've got nothing happening in OPEC for a best part of a month till we meet in Algeria, and that's going to be a very interesting meeting. Hopefully we can cover that one together.
Peter, when I speak to people on the ground in China, they say things are not anything close to as bad as the world makes it out to be. And of course, they enjoy a AA3 rating from Moody's, which is one of the best ratings. Maybe it's very close to the UK, I don't know. But could it be possible that foreign analysts are misreading China? Because, if you just go before 1949, the Chinese have been humiliated into signing treaties and doing stuff by many, many foreign interests. And maybe that's the reason they don't really like to talk too much, and maybe they don't speak English. But are we misreading it? Maybe China is not as bad as it looks.
Well, when you can't have, that's very well put, you can't have a quarter of a century or longer of 7, 8, 9% compounded GDP growth year on year and not have some good times. It's very similar, and I think that only China's, possibly a decade behind it, but we've got wonderful numbers coming out of India, as far as IMF, but roll our minds across to China. You've got 250 million people and growing every day as far as middle class. Now, that's a lot of consumers, and it's a lot of people going from push bikes to motorbikes to cars and so on. You go down the streets of Beijing or Shanghai, and it surprises you how many Mercedes, BMWs and Bentleys you see. So there's no shortage as far as consumerism, and there's plenty of people coming up the curve. So I don't think that the numbers probably are as bad as everyone makes them out to be. Everyone's saying that was over subscribed or overbuilt as far as apartments and real estate, and, the Jim Chanos is saying we're going to see a big correction. They might be right, but at the present time, I don't see too much. And as we all know, a lot of the Chinese hold their money under the bed. So you've got shadow banking and other forms of participation. It's a very difficult one to, I think, cut through to observe, the reality of the matter.
Well, Peter, just one quick question. What are you seeing on the ground in Australia and rest of Asia? Because I see people moving largely from debt into real estate investment funds. And of course, we don't have them in India, so we don't have that option of trying to find that fixed instrument. But are you seeing more monies move towards equities in emerging markets, or really moving just between debt and real estate, or, REITs, so that it remains a fixed income kind of a scenario?
Yeah, exactly. I mean, the REITs are so strong in those markets, and you've only got to see, the development and what's going on. It's fever pitch when you're looking at, the growth of real estate across Asia. Australia on the eastern seaboard is going through a very similar mindset, and you've only got to see what happened as far as Hong Kong, look at Singapore, and of course, putting your mind across to the likes of Vietnam and so on. So they're very strong growing economies. Real estate seems to be with a growing global population, and that puts some mind's eye as far as, where we're sitting at the moment and what our growth forecasts are globally. Now to about 2040, I think we're going to be at about 9.2 billion people. So it's it's the old Maslow's theory as far as, shelter, and that growing pattern and reality of people wanting hard assets. And that's where the REITs and people want to be across those instruments. And I don't think that really will fade away in the years ahead. I think that probably the appetite will continue, and if not, pick up for more involvement in those hard assets.